The much-awaited GDP numbers for the July to September quarter are out, and it is fairly close to expectations. India recorded a GDP growth of 6.3% for the quarter, down from 13.5% from the previous quarter and lower than 8.4% clocked in the same quarter last year. The data released is fairly close to what the RBI had predicted. To give you the highlights, services have done well, but the disappointment is in manufacturing, which contracted by 4.3%. Gross added value, which shows the level of economic activity, also looks quite disappointed at 5.6%. So what does this mean for the economy and what comes next? Before we talk about that, let me go across to my colleague Maithili, who's breaking down the numbers for us.
Well, the GDP numbers that the National Statistical Office released this evening is a mixed bag. The overall number of growth for the second quarter of the current fiscal at 6.3% is bang on target what the RBI had estimated for the second quarter. So that is the first good news. But the not so good news is when you look at the internals, because apart from agriculture and services, which have done well, in fact, services have held on very well at 9.3%, and agriculture continues to show a stellar performance of 4.6%. But the disappointment really is in mining and more particularly in manufacturing, which actually contracted by 4.3%. Given that manufacturing is the sector where jobs are going to come and where you're going to shift people from out of agriculture into manufacturing, the continued poor performance of manufacturing is very disappointing. Just this evening, prior to the NSO release, we got core sector growth, which showed core sector growing at just 0.1% in October. So overall, the numbers, I would say the disaggregated numbers are very disappointing. And if we look at the gross value added, which really shows the level of economic activity in the country, that is even more disappointing because it is coming at only 5.6%. So though the overall growth is 6.3, the gross value added is only at 5.6, which really puts both the Reserve Bank of India and the government in a dilemma. Should they extend support? What kind of support? Should the RBI continue tightening continue to maintain its focus on inflation, or should it pause, if not pause entirely, at least temper the pace of its rate increase? How should the government look at these numbers? Those are really the key questions that need to be asked. Government doesn't have much fiscal space, but to the extent that tax revenues have held up, it is certainly in a better position than it would have dared to think of at the beginning of this fiscal.
Aditi Nayar of ICRA with me on the show. I'm speaking with Madhvi Arora of MK Global and of course DK Joshi of CRISIL. Welcome to all of you and thank you so much for speaking with us again on the India development debate. Mr. Joshi, let me begin with you and your take on the numbers. I mean, it all depends on how you look at it. If I compare it with China Q2, it seems like India is doing pretty well, isn't it?
Well, I think if you compare it to most parts of the world, India would appear to be doing well. But I think the issue is that this growth, as Maithili was pointing out, does hide. The overall growth is good, but I think the underbelly, particularly the manufacturing, is worrying. It's much slower than we expected. Now, I'm a little more concerned about manufacturing because the manufacturing till now had support from rebound in domestic demand, automobile sector, steel and cement sectors, which are linked to the infrastructure spending of the government. Now, I think those will continue, but the external environment, I think, when we move to second half, will turn a little gloomier, I mean, so to say. Exports are already in the month of October, they have shrunk by 16.7%. So what I'm trying to say is that the external stimuli to manufacturing will be much weaker in the second half than it was in the first half. So I think domestic resilience of domestic demand will be tested, I think, in some way as we go into the second half. The second point I wanted to make is that the GDP for the first half has grown at 9.7% overall. Second, we have a projection of 7% for this fiscal year, which means that the second half growth will be 4.6%. So I think year-on-year growth will look quite weak in the second half. I think that's mostly statistical, and I think with some contribution of the global factors as well. I think the third thing is that what will keep supporting growth, economic activity, is the continued rebound in contact-intensive services, which have done fairly well even in the second quarter. We expect this scenario to play out in the next 2 quarters as well, because I think the pent-up demand in contact-intensive services, I think, is still there. and I think that will be of a support. So I think things to watch out for are the gloomier global environment, how it is going to impact particularly the manufacturing sector as merchandise exports slow down.
Aditi, is manufacturing a key concern for you as well? And how much of this can be put down to the fact that these were months which we were facing high inflation? The RBI responded with interest rate hikes, I think 100 basis points of interest rates, hikes overall in this period. How much of a contributing factor is that?
Thanks, Tamanna. Today's headline GDP print has come in nearly in line with what we were expecting, which was 6.5%. And I think the more important thing to looking at a comparison between the YOY growth in Q1 and the YOY growth in Q2 is really misleading, because Q1 was 13.5% on a very depressed base of last year's second wave of COVID-19. It's much better to actually interpret these numbers by comparing them with the pre-COVID quarters, which is Q1 and Q2 of FY20. And when we do that, the growth momentum has actually doubled. We've gone from about a 3.8% growth in Q1 to a 7.6% growth over pre-COVID in Q2. And as Mr. Joshi pointed out, one of the big reasons for that is this continued recovery in the contact-intensive services. And even the trade, hotel, transport component of services has actually been better than the pre-COVID level in this quarter. This is the first time that we've seen the contact-intensive part of services being above what it was in the pre-COVID period. So I would take that as a big win in a sense in terms of the strength of the recovery. On the manufacturing side, my interpretation is that this is a quarter where there was an intense amount of margin pressure. Input prices were very high compared to the year ago period. And I think that is what is lending itself to this contraction in manufacturing, although we certainly didn't expect the number to be this bad. But what I suspect is that it's the margin pressure that's really dampening down on the manufacturing performance in Q2. And at least in terms of the outlook for Q3, I think there are positives, there are negatives. Q3 clearly we kicked off with a good festive season. Some of the heavy numbers like auto output, etc., have been pretty decent, particularly for passenger vehicles and some other segments. And, I will really caution against looking at October in isolation in terms of YOY growths again, because this is a period where we had an early festive season as compared to last year. So my view is that we need to hold off before pronouncing that Q3 is going to be a very weak quarter, looking at simply the October data for things like the core sector and the YOY contraction in exports. It's much better to wait for the November numbers to come in to get a better sense of how the average move for these 2 months, because that's going to give us a much cleaner picture of the underlying growth momentum.
Madhvi Arora, first of all, of course, your take on the numbers and the fine print we've seen today. And let me just hack on another question. Typically, Q3 is better. Can we expect that?
So sequentially, you are going to be seeing a relatively better picture, especially, as on a sequential basis, probably the higher input cost would be lesser of a worry. So that would also imply that the margin compression, at least which was happening on account of higher input cost, could correct. And of course, because festive season would also lend a relatively higher production and demand on the consumption side. So at least on the urban consumption indicators, we are seeing a broad-based improvement. But that said, I think you are also seeing a very mixed recovery in the consumption side of the economy. You're seeing a lot of divergence within urban and rural sector. And in fact, our channel checks also sort of suggest that it has been a very mixed recovery in the last couple of months or so, and the consumption demand hasn't been very secular. So I'm not very sure that the sequential increase that you will see going forward is going to be in line with the last few quarters, barring the COVID quarter. But definitely on a seasonality basis, you would see a better third quarter in general. But again, what you're seeing in the consumption side of the story is that now even the formal sector employment growth seems to be also slowing. We are seeing sequential fall in EPF for new payrolls, and even Naukri job index is also hinting at even the urban income, or urban employment story also fading at the margin, while rural has been relatively a subdued story because the real wages have been largely negative for the last 4 years or so. It's just moving in the +2 -2 range on an average. Thus, that segment of the economy hasn't really seen a secular growth. I think consumption is one story which I believe in the next 6 months or so will probably slow down much faster.
That's then a bit of worry if the consumption story slows down, because right now, Mr. Joshi, what the bet is on is the Indian consumer. And anecdotally, festive period, etc., has seen some buoyancy there. Do you think that's not going to sustain?
Well, I think it will be. I think, as I said, the resilience of domestic demand, consumption demand will be tested. I think, and I think one of the reasons for that, not I think necessarily into the third quarter, but particularly into the fourth quarter, which will be January to March of next year, will be the interest rate hikes that RBI has done so far will start impacting the consumption side, or it starts biting, I mean, with a lag of 3 to 4 quarters. So when that happens, I think the global environment is not turning good. I mean, that is for sure. So I think in that scenario, because the export demand will also be weak. So I think the entities linked to export sector will not perform that well. So there is I think these will be testing times for the strength of domestic demand, and I do feel that government will try to address it through the budget by focusing on capex, and I think that's what they have done in the last in the current fiscal year, and I think that strategy is going to continue next year as well to cushion, because the infra spending does have spillover effects over time. So some of that effect will also play out. But I think these are very uncertain times, very hard to be precise on numbers right now. But I think directionally, yes, I think I do see weaker in terms of year-on-year growth, a weaker second half. That is purely statistical. We still expect overall GDP growth at 7% for 22-23, which is reasonably good.
So, Aditi, let me come to you on that. Where is forecast there for India's GDP growth? Most of them are lowering from what they were earlier. Most agencies are doing that. But do you think that 7% benchmark we can hold on to?
So as of now, we are holding on to our 7% plus forecast, and we will review it once we have a clearer sense of how November has moved, for two reasons. One, festive season, to my mind, was actually a little better, a little stronger than what we had expected. Does that sustain? Was it purely pent-up demand for festivities, or is that going to sustain? Or are we going to see that our consumers are actually cutting back on spending because they've overspent earlier on in this quarter? So we'll have a better sense of that in the next couple of weeks as data starts coming in for the month of November. Secondly, exports, certainly we need to watch out and get a better understanding of how quickly the global slowdown is going to percolate down into our exports. So there could be sectors where, at least in the immediate term, orders have already been booked, and therefore the impact may be a little more back-ended. It may not be immediate because they've already got their orders in place for the Christmas season, etc. So again, that is something that we need to get a little more clarity on. Rabi sowing has picked up much better than what we were expecting. We're looking at some 7 to 8% growth right now, and the acreage for wheat and mustard in particular is quite healthy. So that is something that may sort of bolster the rural segment going ahead. And I think Maitri talked about the lack of fiscal space. I think she was referring to the center, because our calculations show that actually state governments have a huge fiscal space to be able to spend on capex. But can they? Will they really step up the pace of execution? That's something that I don't have an answer to right now. One more sort of positive is that we've seen a lot of project announcements, or a lot of announcements this month in terms of or this quarter in terms of capex, because many states have had their investor meets. So that's generally signaling that there is some intent to invest going ahead, but we don't think that it's going to be immediate. So it's going to be more back-ended and not immediate, even though the project announcements will spike in this quarter.
Maitri, your take on, of course, the overall, what will we end this year with, that 7% benchmark, and whether Q3, as it typically does, will reflect some of that festive fervor we've been seeing and talking around us? Or is that, very small bubble that we've been living in?
So we are also retaining our 7% forecast at this point in time, although there is clearly appearing to be some downside risk to that. For me, the bigger problem is that I'm still not seeing any secular agent to, the economic recovery or the next leg of, the sustained growth that one is talking about. To a large extent, private consumption and private investment are pretty endogenous to each other. So my sense is that, we are already seeing the formal sector employment sort of slowing. The wage bills are also, formal sector will also probably reduce over the next quarters or so. So at least the urban income theme may also not be as robust as it was in the last 1 year or so. As I said, rural anyway has been pressurized for the longest period. If private consumption doesn't see a secular uptick, there's a little chance that private investment will also follow suit with a sustained trend, especially when you're looking at global uncertainty around. So to me, that becomes a bigger worry. Managing a 7% won't be that big an issue, even though sequentially, second half of the year, we will see a much slower growth because of the base effect. But I think going ahead would be something that we are looking at as a much more secular problem for us rather than just looking at the next 2 quarters, because there would be some slower growth. A part of it is also because of the base effect, and also the kind of uptick that we've seen in consumption the last couple of months or so also has the festive effect, plus it was the first time that we've seen the economy fully opening up. So there's a bit of a dirty data assessment that you can probably have out of the current dynamics that we're seeing in consumption. As I said, our own channel checks are showing, especially in the rural sector, a sense of gloominess at this point in time, a lot of mixed momentum in terms of data also. So I'm not very sure whether, again, as I said, consumption is something which I'm tracking very carefully. In the last couple of months, the way India has grown versus the rest of the world has been a story of consumption, which also has come at a cost because net exports has become a drag for us. Also, it is also reflecting in a higher current account deficit versus the rest of the world. Somewhere the imbalance or the fact that India is outgrowing the world will show these imbalances in some form or the other. So that clearly at this point in time looks to be a worry for me. And I think for me, unless I'm seeing a secular agent of recovery, be in the form of exports or in the form of private sector consumption or investment, I'm not sure whether I can call it a relatively stable growth story for India as we go ahead beyond FY23. But for 23, I'm retaining my forecast 7% as of now.
Interesting. That's an interesting take. I'm going to get DK Joshi in on that this Indian consumption growth story also comes with an increase in imports. And how sustainable it is the question. Now, you spoke about government response in terms of capex. What can be done to spur private investment?
Well, I think one is when you do capex in infrastructure, that spills over to the private sector because I think there is a multiplier effect, so to say. It crowds in private investment. That is what the theory tells us. So some of that impact will play out. But apart from that, I think for private sector, what they have already what the private sector will be a little shy of getting into a investment cycle into a broad-based investment cycle because there is a huge amount of uncertainty. We should recognize that investments by private sector are happening in some of the sectors. One of the steps that government took to take care of this uncertainty and fast forward some of the investment was through the PLI scheme, which actually helped electronics and pharmaceuticals this year. Next year, I think we believe it's going to help solar panels, etc. So maybe something like a PLI which can fast forward and take care of, address some of the uncertainty concerns that the private sector has. I think that will push private investment up.
Aditi, in terms of fixes, responses from the government, of course, and on the monetary side as well, how do you see that panning out?
See, fiscal, I think the next budget needs to again prioritize, keep as much space for capex as possible and really target the sectors where the spend can be quick. But that's something we say every year. And hopefully, we will see a growth supportive budget coming in a couple of months. On the monetary side, my sense is that we're looking at a period where, growth has now come in line with what the MPC had projected for Q2. Inflation has slowed in October. We are expecting it to come down further in November, but still remain above the 6% upper threshold of the MPC. So our sense is that possibly we're looking at a smaller quantum of a rate hike in the December policy, which is just a week away. So possibly 35 basis points in December. And after that, I think we really need to go into a much more sort of data-dependent mode. Does inflation come below 6% by the time the MPC meets in February? What does the budget say? And with all of these concerns that we're talking about, not a lack of certainty on what is going to be a sustainable path for consumption going ahead, how quickly does the external slowdown bite into exports, we'll have a better sense by the time the MPC meets in February. And I think by then, it will be clear whether the balance of monetary policy needs to tilt back towards supporting growth or remain firmly fixed on bringing inflation below the 6% threshold.
Your take on the kind of fiscal and monetary responses that we can see?
So I think we are largely going to be seeing a neutral fiscal as well as monetary policy impulse in the next 1 year or so. So while the policy focus could probably continue to be a tad biased towards capex, I think on a broad basis your fiscal multipliers are going to be relatively much more muted because you're going to be seeing still a consolidation, at least on paper. So that itself, I'm not expecting a very sharp consolidation in the fiscal deficit in the next year, but definitely direction is going to be, going towards a much lower fiscal deficit. So even if I assume a 30 bips correction, I don't think the fiscal multiplier impact would be very meaningful. So I think we are largely going to be seeing a fiscal neutral policy behavior on net basis. We can target certain sectors and priorities, but in the end, the fiscal impulse on the overall economic output is going to be largely neutral for me. For monetary policy also, I'm expecting the RBI to not get too restrictive in terms of rate hikes. So as per their own estimate, the real neutral rate for them forward-looking not get too restrictive in terms of rate hikes. So as per their own estimate, the real neutral rate for them forward-looking neutral rate is close to around 1%. So if I'm looking at inflation ahead, 6 months ahead, also close to ending around 5.5%, I think even if they stop their rate hike at 6.5%. I think largely it's going to be monetary neutral. So for me, policy both end are largely going to be net neutral as far as the macro impact or the impact on output is concerned.
Absolutely. So interesting times ahead, quite fluid, but what this GDP print is telling us is that India needs to find more ways to shield ourselves against the global hailstorm that's coming. Thank you so much to all of you for joining us on the show today.